Good morning, everyone. Thank you so much for joining us today for our webinar, our Expert Week webinar on U.S. income tax implications for manufacturers doing business internationally. I'm Melissa Grosso. I'm the director of the U.S. Commercial Service Office here in Middletown, Connecticut. Very pleased to bring you this webinar on a super important topic and a continually developing topic. Just a couple quick housekeeping items before we get started. We are recording today's webinar, so if anyone objects, you can disconnect now. We will have a Q&A session at a couple different points during the program. To enter any questions at the bottom right corner of your screen, you'll see a Q&A button or a chat button. Feel free to input your questions there. Again, we are recording the webinar. We'll send you a copy of both the slides as well as the recording after the program. Just a quick note about the U.S. Commercial Service. We are the trade promotion agency under the U.S. Department of Commerce. So day in and day out, we help U.S. companies who want to sell their products internationally. Great resource for U.S. companies. We do have offices in almost all 50 states. So if you'd like to get in touch with your local office, I've included a link here on the screen. And additionally, during the rest of the week, we do have probably another 15 or so webinars that are taking place. So definitely encourage you to go to our website and sign up for any that are relevant and of interest to you. And with that, a huge thank you to our partners and our speakers today from Marcum. I'd love to introduce Jeff Rossi. In addition to being a member of the Connecticut District Export Council, Jeff is an assurance partner at Marcum's Hartford offices and serves as the New England Consumer and Industrial Products Leader. Jeff has nearly 30 years of experience providing audit and assurance services to Tier 1 aerospace, defense, automotive, food manufacturing, sanitation, recycling, construction, and logistics companies. In addition to being a certified public accountant, Jeff holds credentials of certified fraud examiner, and he has extensive experience in forensic accounting, internal controls, and fraud prevention. So with that, Jeff, I'll turn things over to you. And again, thank you all for joining us today.
Thanks, Melissa. It's a pleasure to be here today. We've got a couple topics on the agenda. Mike's going to be talking about the research and development tax credit, specifically Code Section 174. We know that's giving a lot of our manufacturing clients some pain this season as they look to implement that legislation. And then Andre's going to follow with international tax topics. There's a lot happening in that arena. Andre is one of our international experts. We figured it'd be fitting here at your Export Week, and definitely a thank you to Melissa. You know, I've been serving manufacturing companies for 30 years, as Melissa alluded to, and it's amazing all of the support that Commerce provides that a lot of people don't realize. So thank you all for joining us today, and we'll turn it over to Mike.
Thanks, Jeff. Hi, everyone. My name is Mike Pizzullo. I'm a tax partner here at Marcum. I specialize and focus in the manufacturing and distribution industries. I work with a number of privately held and private equity-backed companies, primarily in the aerospace and defense, automotive, and kind of consumer goods niches. So a brief overview of what we're going to be talking about today. I know a number of you on this call are already likely claiming R&D tax credits, but we thought, as we talk about this issue, the Section 174 R&D expenditure add back that's hurting a lot of our manufacturers, we needed to tie that into the R&D credit because they kind of go hand in hand with each other. So we'll do a very brief overview of the historical R&D credit that I'm sure most of you are familiar with. We'll talk about an overview of Section 174, how it came about and kind of what it means and how we got to where we are. Given that this is year one, we'll go through some of the implementation issues that the companies have been facing and continue to face as we're in our summer filing season now. And then we'll talk about some of the latest developments in Congress related to 174 and where we see the section going, both potentially retroactively for this year or for 2023. So with that said, here's a brief overview of the tax credit. The code section that governs the R&D tax credit is Section 41. And I mention that really only because I wanted to point out that it's not Section 1. It's a completely different section of the code that governs the credit. It does reference 174 in its guidance, but there are two distinct kind of sets of guidelines that are going to cover what you've known historically through the R&D credit and what you might, what we're up against this year for the Section 174 R&E add back. So the items that I'm pointing out here are deliberate in that I want to compare and contrast them with what you might be hearing or seeing with your Section 174 analysis. So Section 41 is very clear in what it prescribes as costs that qualify for the research and development credit. That's your salaries and wages, supplies, and contract research payments that you make. There's a haircut on the percentage you can take, but it's, generally speaking, it's these three buckets for US-based R&D, and that's what will go into your credit kind of base for the calculation. To qualify under Section 41 for these expenses, you have to be undertaking qualified research. So there are a couple specific terms in the last three bullet points here that I wanted to point out. One is they may provide some of our manufacturing companies an opportunity to claim the R&D credit that you might not think, naturally think of when you think of certain components of manufacturing, but also to contrast them later on against the 174 add back. So the research has to be done with the purpose of making some discovery that's technological in nature. So technological is the key component of that. It's not artistic or stylistic or design. There has to be some technological benefit we're gaining by undertaking these expenses. The second bullet point is one that will allow, that I want to talk about shortly, that may provide an opportunity for some manufacturers to capitalize on in an area that maybe you're not normally thinking about. But you need to be improving or developing something new. And business component here is the phrasing that I want to key in on in a moment. But it can be an improvement, a product improvement or process improvement. It doesn't have to be something brand new. And the process has to involve some experimentation. There has to be some risk associated with it. The outcome can't be a foregone conclusion. There has to be a possibility of failure. So with that said, I think I've mentioned the risk of loss or an element of uncertainty here. But what I'd like to point out for the companies and everybody participating in this hall are process improvements. A lot of times we think of the R&D credit as, technicians in lab coats, or we associate it with software and high-tech industries, not traditional manufacturing or high-tech specialized manufacturing. But the R&D tax credit, the code considers process improvements a business component. So it doesn't have to be a prototype, which you might think of as like the typical business component, this, groundbreaking new product. A lot of companies coming out of this post-pandemic era have made significant investments technologically in, process improvements, line improvements, new equipment. So this is an area that our manufacturers can take a look at and see, hey, did we go back and solve some issue that's been bugging us through a technology solution that we can then turn around and monetize through a credit. So that process improvements piece, if you haven't, investigated that before, definitely put that on your follow-up list, because there's a potentially really good opportunity there for manufacturers. And then the last thing I really want to mention about the R&D tax credit, generally the credit's 20% of qualified research expenditures over a calculated base amount. There's also an opportunity for small business taxpayers and startup companies effectively to claim the R&D tax credit against payroll tax liabilities. And I know many of us aren't in that situation anymore. We've got mature businesses, but I mentioned this again just to contrast about some of the developments that are potentially coming out of Congress and what they're proposing. So unfortunately, I'm sure a lot of you have experienced some level of frustration with Section 174. So let's compare and contrast what you're used to from the credit, the Section 41 credit, and then Section 174. So again, we mentioned Section 41 R&D tax credit. You have these three cost buckets: salaries, wages, supplies, and research costs that you're looking to develop the credit. Unfortunately, with the implementation of Section 174, the definition of what qualifies is much more broadly construed. It's loosely defined. There are tidbits in the code and in primarily regulations that'll give you some idea of what kinds of costs you're going to be looking at and doing an analysis on. But I've included, in the first bullet point under 174 here, kind of an example in the regulations of how it is very loosely defined. You can read this and kind of wonder what that actually means at the end of the day. There's no IRS bright line or Treasury bright line, safe harbor, look to these five kind of cost buckets. Whereas for the Section 41 deduction, it's very clear. There's no overhead allocations of costs. There's no kind of soft costs that are included in there. It's very prescribed. So right off the bat, 174, is complicated and challenging compared to the environment that we're been historically used to with the R&D credit. You can kind of think of, everything that goes into the R&D credit will go into 174, but 174 is going to, scoop in a lot more costs that the companies and manufacturers are going to have to analyze without a whole lot of guidance currently right now from the IRS and Treasury. So how did we get here with Section 174? So originally, it came into the code in 1954, and it was a way for there to be some kind of certainty around what to do with these R&D costs. Without Section 174, we'd be relying on Section 162 here, which is really just allows companies to deduct ordinary and necessary business expenses. So when you're looking at R&D projects, back pre-174, how would you be able to determine what's currently deductible versus what is kind of a capital investment in nature, has a long-term benefit? What's the life of that benefit? How should it be amortized and deducted over that period? So 174 provided some needed clarity there by just saying R&E is deductible currently. So that was old law. The last major tax act we got was under the prior administration, the Tax Cuts and Jobs Act that came in at the end of 2017, that had a number of changes. It fundamentally changed the way partnerships were taxed. As Andre is going to discuss, it changed the international taxation regime. There were so many changes in that bill that the 174 change, which was delayed for a number of years, here we are, it's effective for tax years beginning after December 31, 2021, effectively 4 years after this act was passed, we're now dealing with this code section. It's kind of lying in wait. And it's been universally unpopular in Congress and the manufacturing and business community, as well as the profession for accountants, given the amount of guidance that we've had to help taxpayers and clients navigate this environment. So here we are, 60 some odd years after the original 174 went in. The Tax Cuts and Jobs Act modified it so that we can't currently deduct these expenditures anymore. We've got to capitalize them. So for US-based costs, we're capitalizing and amortizing over a 5-year period. For foreign research items, it's more painful. It's a 15-year amortization period. Now, comparing this back to the Section 41 R&D credit, you weren't even allowed a credit for foreign R&D costs. Here, we've got to look at them and amortize them, and it's over an extremely long period. And then that amortization, in year one, or the year the costs are incurred, the code prescribes that we've got to amortize it, basically taking half a year's worth of amortization using a midpoint convention. So 174, as we mentioned, is the costs that get sucked up into that are very broadly defined. The one area where it does explicitly provide guidance are software development costs. So software development costs are considered R&E and have to be capitalized and amortized. The code also prescribes the treatment when an R&D project is abandoned and you have capitalized costs sitting on your tax balance sheet. And in effect, or you have a sale event. In effect, it's a very taxpayer unfriendly provision that says you ignore that disposal or abandonment event and you continue to amortize those costs over the remaining useful life that exists. So that's not even potentially a today issue with 174, but there could be lingering hardship for taxpayers. If we've invested all this time and money and scrapped a project, we still can't take that benefit, into taxable income. So here we are, and presumably we're calendar filers and we're in the 2022 tax year. This is a change in accounting method, given the way we've historically been able to treat 174 costs and the way we need to treat them today. So the IRS normally requires a change in accounting method be filed here. And for those of you that have gone through the process, there are automatic changes and there are non-automatic changes that you have to apply to the IRS for. The IRS came out with some guidance that said for year one for this issue, you can include a white paper statement with your tax return that includes certain disclosures that say basically, we're adopting 174. Here are the costs that we're including. Here's the amount, and you can move forward. So if for some reason we're not adopting that this year, a change in accounting method, this Form 3115, would be required in a future year. But for year one, at least procedurally, there's not, an extra filing due on taxpayers' parts. Now, with any tax law change, we have federal tax law change, and then we always need to look at the states because the 50 states have 50 different ways of doing anything. So I've listed here the most recent data on which states do not conform with Section 174. I haven't called it a decoupling because some states haven't actively gone through the process of decoupling from 174. Some states have just adopted the federal tax code as of a certain date, which does not include the change for the Section 174 capitalization. And even within that, you can see here for Kentucky and Mississippi, it's, their dates don't necessarily follow the calendar dates. Kentucky, we don't have to do it this year, but if it stays law in 2023 tax years, you're going to be doing it. Mississippi, we have to do it this year, but not next year. So the only other one I want to point out specifically is Texas, which no longer has an income tax. It has a margin tax. And R&D costs are still currently deductible in costs of goods sold. So we have a federal treatment, which is unfortunate. Some states here have nonconformity with 174, which is nice. The other consideration is, as Andre's going to get into, is the TCJA fundamentally changed the way we look at international taxation and foreign-held subsidiaries. And 174 applies to those entities as well, particularly as you're looking at your, what's called the GILTI, in the kind of mandatory repatriation of earnings taxes here, or income inclusions. 174 comes into play. So it's not just a federal issue. It's, for our group here in Export Week, where we're doing business, cross-border and all over the globe, there are far-reaching implications and considerations that we have to address with 174. With that said, what's the future of 174? This is kind of where the rubber meets the road for us. We've talked about how to, in general terms, how to treat the cost, but what's going on with this? There's a lot been written kind of in, from public accounting firms like ourselves, a lot of guidance, that's been suggested in Congress. But again, universally, this is a very, very unpopular provision. And we as advisors and you as business owners and operators are stuck right now because the law is the law. We've heard for over a year now that this is very unpopular. There have been attempts back in 2022, as part of the initial drafts of the Build Back Better Act, to get 174, this change, off the books. But right now, it still is law. So we're past our extension filing deadlines. We're into our summer filing season. The reality is these 174 costs have been crippling to manufacturers. This add back is just cost prohibitive. We've had a number of manufacturers just say we can't, in effect, we can't afford to pay the tax if this provision is coming out of nowhere and forcing us to pay. Everybody, professionals, companies, Congress, thought that this was not going to be law as of December 31st, 2022. So we're here. It's also affecting 2023 estimated tax payments, because whether you're looking at safe harbor calculations based on 2022 actual taxes, which have 174 add back in it, or you're looking at your current year operations, they're still high because of these 174 add backs. It's a timing difference, but we're still building up that timing difference. In 2023, we'd only be in year 2 of these R&D add backs, where we don't have enough amortization coming in from prior years to really offset enough of that add back to help companies out. And it's so loosely, some of it is so loosely defined that we need additional regulation and guidance specific to 174 and the changes made by the TCJA. Once we're in this out of Section 41 and into 174, looking at all the different overhead costs and indirect costs that could be allocated into this add back, it's almost like a thread that you can start pulling, and where do you reasonably stop? So in the absence of really good guidance or safe harbor positions, it's very uncertain for taxpayers. So as I mentioned, towards the end of last year, the original drafts of Build Back Better were supposed to rectify 174, and we'd get some type of deferral, or we'd completely scrap the change made by TCJA. Earlier this year, in 2023, the AICPA has lobbied to get this kind of front and center, and to get this change either deferred for a few more years so we can maybe come up with some better guidance around it, or permanently get rid of the change that was made. So that's coming from our side on the accounting professional perspective. But there are two right now, one in the Senate and one that very recently started to work its way through the House that would address this. So we'll start with the Senate proposal, because that's the slightly older of the two, which started to be kicked around in March, and it would bring 174 back to the pre-TCJA standard, where we could deduct research and experimental expenditures. That bill is not, that proposal is not considered, a clean proposal, in that it doesn't just make that change. It also wants to expand that R&D payroll credit opportunity that I talked about earlier on. So for small businesses and startups, it would extend the life, the kind of look back period, or the testing period, for who would qualify to take this credit against payroll taxes versus pass through or on your corporate income tax returns. The House bill, which is the most recent, a couple weeks old here, would propose the clean approach and just revert 174 back to a situation where we can all just expense it in the normal course of business, as we've been doing. So there are proposals out there, and these proposals would be retroactive. So, if you've filed your tax returns already, there may be amendment opportunities there if this has impacted your business, or hopefully your tax return has been extended while some of this happens. With no crystal ball, it's hard to say exactly when this may come to fruition. Presumably it'll be there or won't be there for our 9/15 and 10/15 filing deadlines, but as we're all well aware in this current environment, it's getting even some standard basic blocking and tackling done can be a challenge in Congress. And it's not going to be next week that we're going to have clarity on this. It's going to be later in the summer. It'll be a July or August timeframe when we'll have, I think, some very good clarity on where this is headed. And the best advice we can give you is to stay close to your tax advisors on this. Monitor the developments with them and really understand what it means from a cash flow perspective, for your business as we're moving through 2023 and you're working up your tax planning and estimated tax payments. So with that said, I unfortunately, it's not the best news, but it's reassuring to know that, if you look at the timeline kind of laid out on the slide, it's starting to pick up momentum. It's picked up on some level in both houses of Congress. So hopefully, in another couple months here, we receive some, as a manufacturing community, we receive some good news. Melissa, did we have any questions in the chat or anything for 174?
I am not seeing any questions just yet. And again,
Okay.
for folks, a reminder, you can put your questions in bottom right corner of your screen. You'll see the Q&A box or the chat feature.
Mike, I know we've been proactive working with our clients to try to minimize the impact of this. Obviously, recommending the extension first. Second, we've worked with clients in regards to the payments that they've made. Some clients have elected to throw the dice a little bit and gamble on this being repealed. Obviously, those are the clients that didn't have the cash readily available to just float with Uncle Sam. And then the third aggressive reaction that we've done with some of our clients is we've implemented full-blown studies to try to dig deep and have a defendable position to make sure we get the right, as best we can, get the right pool of costs aggregated to be in, I guess, a offensive/defensive at the same time position with the final filing if this does not get repealed. Any thoughts on any of that?
Yeah, given these conversations are hard because of the timing of when this provision became effective. It had kind of fallen off the radar, after the business world reacted to TCJA and implemented all the changes and comfortable with those changes, this one kind of fell under the radar. So especially if you were in a position where you weren't, you weren't aware going into the 2023 filing season that this existed, it's been a sharp snap to reality for a lot of companies. And like you've said, we've seen things within a range of approaches. I would say that it's, at this point, it's a business decision with your advisor, and each company's circumstance is a little different in how you're kind of mitigating or hedging against it, because you do have some flexibility in, belts and suspenders and doing a very deep 174 study and knowing that number today, but also knowing in 2 months that number may mean nothing and you've incurred time and an investment to get there, versus maybe potentially, on your estimates or your extension payment. I've had companies say to me, we want to assume that we're getting the glass is half full and this thing's getting repealed. So we're gonna run the risk of some interest and penalty until we have clarity, because we don't have the cash to meet this, and we think it's, in their mind, clear that we're gonna get some type of relief. So, the best advice I can give is, you have to take the 2 years, 2022 and 2023, and consider how you're basing cash flow projections and estimates in the current year around 174, and make the decision that's right for you. There's certainly not one size fits all, given how impactful the cash flow impact of 174 is.
Thanks.
All right. If there are no other questions, Melissa, I'm happy to turn it over to Andre. And if there are any at the end of the presentation, if anybody thinks of anything, I'd be happy to answer them then.
Perfect. Thanks, Mike. And Andre, you should have control of the slides now.
I do. Mike, that's a lot to think about. Thank you. And some of it, as you mentioned, is also mine to think about. We do have some cross-border issues with 174 that Mike raised, and we're gonna talk a little bit about it again as a refresher as we go through this course a little bit. Just by way of what we're planning to do in the next 45 minutes or so, give or take any Q&A that might pop up, is talk a little bit about international tax, about how to source the income that you have and why does it matter and what's the purpose of sourcing your income between U.S. income and non-U.S. income. And we're going to talk a little bit about GILTI, which has come up a couple of times in Mike's discussion, subpart F, which is considered like a sibling to GILTI. We're going to get into that a little bit. Number 5 will be FDII, the foreign-derived intangible income regime, which is a new regime from 2017, which incentivizes the exportation of goods and services. We're going to talk about that a little bit, and then come back to maybe some of the 2024 Green Book proposals that came out late in March, so maybe 6 weeks ago, and what they might do to change the GILTI regime. So that's the agenda for today. In terms of me and my background, I'm the national practice leader for international tax for Marcum. I spent a lot of time after law school in Manhattan dealing with international tax matters for Fortune 500 companies. In the last 6-7 years, I've pushed into the middle market and provide a lot of this work in the middle market. My historic background was indeed in the manufacturing and distribution space. So regardless of the fact that I do everything, this particular industry is near and dear to my heart. So I jumped on the chance when Jeff reached out to be able to speak to everyone a little bit in this market. Okay, so let's talk a little bit about sourcing of income. Now, the way it works is we all know we have gross income and we have our expenses, and the two net and we get our net income. And that remains true in the international space. There's nothing particularly different about that general concept. The question is going to be, in which basket does this income belong? If this income is from a U.S. source, then your gross income is U.S. gross income, and certain deductions will get allocated against that income in your U.S. basket. On the other hand, you might have income that's foreign sourced, and there are multiple baskets of foreign source income. That's why you'll see in this little picture at the bottom, there's sort of different cylinders there, the different baskets. And those different baskets are foreign source baskets, and the deductions that go against them may go into one of those foreign source baskets. Now, what's the point in taking your income and trying to figure out your gross income and your expenses and which basket they go? Why does it matter? Well, it matters for one really important reason, which is called foreign tax credits. Foreign tax credits are this concept that when you pay taxes outside the US, income taxes, and maybe I'll make that clear, most of this presentation is income tax related. There is a VAT tax, which is a foreign equivalent of sales tax. There's customs and duties taxes, and all of that stuff applies in cross-border distribution and sales, but we're going to focus on income tax today. So when we talk about foreign tax credits, coming back to the slide at hand, we're going to talk about income tax. So if you pay an income tax outside the US as a US company, can you take a credit for that foreign tax paid against your US tax liability, right? To avoid the double taxation, the being taxed in a local country and being taxed again here in the US. And the answer is, generally speaking, in the US you can, but there's a limit. There's a limit to how much of your US tax can be credited with foreign income taxes that you paid. And that limit, which I put on screen for some of those who like to see math, it's a bit of a fraction here for those who like fractions. But what it's basically saying is you can take a credit against what US tax you would owe, but it's limited to your foreign source net income out of your total taxable net income. So without getting into too many details, if 20% of your net income is from a foreign source, then 20% of the taxes that you would owe in the US can be credited with foreign taxes paid. So it's important to know what your percentage is in order to be able to know the maximum amount of taxes that you might have paid that can be used as a credit. So that's the importance of understanding the sourcing rules. Now, I didn't get into the baskets up till now. There are multiple baskets. You see at the bottom there, there's general, passive, branch basket, GILTI basket, and treaty resourced income basket. Those are your popular ones. And your ability to take a tax credit for taxes you paid is limited on each of those baskets. So it's not all foreign income against all income. It's foreign income in each one of those baskets out of total income. And then the taxes associated with each of those baskets is what can be credited up to that limit. So you really have to understand a lot about sourcing of income and the different baskets to really know the answer as to, well, what can I credit and what can I not? And if I can't credit in the current year, just for those who are asking, there's a carry back for a year, and then you can carry forward those taxes up to 10 years for credit in a future year if the math works out that in a future year you have an ability to take more credit than the taxes paid in that future year. So then some of these taxes you couldn't credit in a current year can be credited on a go-forward basis. So that's the reason to understand sourcing of income. So we're going to keep moving on into this. So I will get to some of these chat questions, I think, a little later on. I don't want to interrupt the flow too much, but I promise. Thank you for listening and thank you for writing, and I will leave time at the end and I will get to those. Another area that people consider the sourcing of income important is whether or not the U.S. has a right to withhold tax. So, for example, certain dividends, certain interest, rental income, royalty income, certain passive type income and of this nature, the U.S. can potentially withhold on, but it has to be sourced from the U.S. The U.S. has no right to withhold on these kinds of passive incomes if they're not sourced here. And so the determination as to whether that income is sourced in the U.S. is step one in determining whether there's any right to withhold. And the withholding is often done on either forms W-8 or W-8 or things of that ilk. And so therefore you see the top couple of lines of one of the W-8s as a reminder as to what forms those relate to. Okay, so income sourcing. Now we've sort of said, why does the sourcing of your income matter? It affects ability to take a credit. It affects when the U.S. can actually garner withholding. So how does it work? Well, there are a few ways in which sourcing of income generally works. There's the predominant situs rules, the residence of the recipient, and the sort of split source, which splits U.S. and source based on certain allocations. And these are your general rules, but we're going to get a little bit more detail than the general rules. So, looking here, income classified based on the location of the economic activity are your sort of predominant situs rules. And here you can see interest and dividends in different kinds. And I'm going to go through some of these in even more detail in a little bit. So I'm not going to spend too much time on this. Residence of recipient is one of the other major ways that you source income. And that's usually based on the resident of the recipient of the property, which would include things like sales of personal property that's not inventory, and a few other things, ocean and space income, which you can't really allocate somewhere else, and certain currency gains, which again, we'll get to. The last of the three major buckets of how to source income is the split source rule. And this rule can be used to split your income into different sources. And it's often used for the transportation income, international communications income. Historically, it was used in the manufacturing space under manufactured sales of inventory. But with the Tax Cuts and Jobs Act, that's changed quite a bit. We're going to come into that a little bit later, but some of you in this space may be familiar with the old 863B split source rules for sales of manufactured inventory, which has somewhat changed, and we'll talk about that a little bit. Okay, so when you want to source your gross income, there are two sort of steps to that. First step is you got to figure out what kind of income you have, and then look to the rule that relates to that kind of income. And when we talk about what kind of income, we're talking about these kinds on the left: interest, dividends, services income, rental income. You have to sort of give a name to the income you have. And once you give a name to the income, you can go into the code, the tax code, and here are the sections generally applicable, and say, what's the rule for that kind of income? So that's your two-step process. Give your gross income a name, a category, what is it? And then go find the rules in the code that tell you how to source it, and then apply that rule to the facts relating to your kind of gross income. We're going to do that a little bit in the next few minutes just to give you a flavor for how it works. I may not go through every one of these just for a matter of time, but I do want you to see how that sort of looks. So, okay, In terms of the sourcing rules, there are really 5 sections of the code that deal with it. 861 tells you when things tend to be US sourced income. 862 tends to mimic 861, but tells you when it's not US sourced, meaning foreign source. 863 of the code generally deals with those split source rules, which we're going to get into. 864 has special rules about in the United States. Most of this 864 rules apply to non-US persons coming into the United States to do work. And then 865 often deals with sale of personal property, the general rule being that it's sourced by the recipient. That was one of our 3 major buckets, but then you'll find out that 865 has like 8 different exceptions that can erode the original rule. So how much does the original rule matter when there's 8 exceptions? That's up to debate, but we'll get into some of that. Inventory, if you buy inventory, you're going to see that, income from the sale of inventory that's purchased and then resold is usually it's sourced based on where the title passed. So this is not for manufacture. If you're manufacturing your own inventory, you're going to come into some different rules below. But if you're buying inventory and then selling, where did you pass the title for that inventory? That's going to be your decision. And so for those of you who are thinking critically, we said earlier, your ability to take a foreign tax credit is limited by your foreign source income out of your total. So what that means is the more foreign source income you have, the more foreign taxes you paid, you can credit against your US taxable income, US tax base. So for example, looking at this first rule, purchase of inventory, if you pass title outside the US, it's foreign source, that increases your ability to take a foreign tax credit for any foreign taxes paid. So, when you come to an expert like me and we look at the foreign taxes you pay and how much you get a credit for, if I find you're not getting as much credit as you're paying abroad and you're sort of paying double tax, I may work with you to think about purchased inventory and passing that title abroad in order to get more credit for foreign taxes, right? Really basic idea of a strategy, but it might help change your taxable position. So that could be something really important in the manufacturing space. Manufactured inventory, not the stuff you're just buying and selling, but manufactured inventory has its own special rules. Before 2018 in the TCJA, which is the Tax Cuts and Jobs Act that Mike mentioned, before then you had this split rule method where part of it was based on where you were doing manufacturing, and part of it was based on where you passed your title. Unfortunately, sort of post TCJA, for manufactured inventory, the rule is now just where the production occurs. So unless you're going to move production outside the US, you can't just pass title outside the US and get a portion of your manufactured inventory to be foreign source. But you used to. Now you can get some of that to be foreign sourced if you have actual production outside the US. And we'll talk about some of those things later on. Okay, so we just talked about this, part of it being sort of where you pass title. That's the bottom fraction. The top fraction in this slide is sort of where you produce the inventory. So that was the rule before 18. Unfortunately, today it's not. So okay, that's what I'm going to say on sourcing of income in terms of how do you source it. There's a lot more to it. Those rules are quite complex, but just to give you this idea of your sourcing of income and then trying to proactively source income in a way that's going to allow the maximization of your foreign taxes to be credited, right? That's just the way you plan, good planning for international tax. So if you guys are dealing with cross-border sales, and if you are paying any foreign taxes, income taxes, doesn't apply to VAT and other taxes, that's a different matter. But sort of it's important to work through that. Okay, so let's go from there to GILTI, and I'm debating whether to hit the chat stuff now with respect to sourcing and then do it at the end of each section. Let's see what's in there. Let's see. How do I read? I'm not sure.
No questions yet, Andre, that I'm seeing in the chat.
Okay, perfect. I thought I saw something popping up. I guess not. So that makes it real easy to make a decision. We get to just go forward into GILTI. So GILTI, before I get into the details, although Mike did mention it before a little bit, GILTI is a special rule that was implemented in the Tax Cuts and Jobs Act, but it has a brother rule in subpart F that's existed since before 1962. So some things are new, but some things are not. To set the stage for GILTI, this is something that's generally applicable for CFCs. CFCs is a term of art, it's controlled foreign corporation, but for people who like to speak in plain English, if you're a US company and if you have a foreign subsidiary that you own, let's say you have a manufacturing subsidiary that's outside the US, or you have a distribution entity that distributes, either locally in a jurisdiction, or maybe you have a hub in Netherlands or Ireland that distributes to all of Europe, right? That may be 100% wholly owned subsidiary of a US multinational. When you have these controlled, it doesn't, but it does have to be controlled by US persons. But if you have a controlled foreign entity that might be doing manufacturing or distribution, that entity is considered, generally speaking, a CFC, a controlled foreign corporation. And that means the earnings and profits of that controlled foreign entity are potentially subject to these GILTI rules that we're going to discuss, as well as the Subpart F rules, which come next. What those fancy terms mean is some or all of the income of these foreign entities could be potentially taxable in the US on a current basis, regardless of distribution. And a lot of people get a little surprised to find out that that can occur under certain circumstances. So imagine that you have a US company and it thinks it's paying tax on all its US income, and then it has a subsidiary in Netherlands that's a distribution hub for Europe, and that distribution entity's made $100 of its own income, and you find out that the US parent has to include some or all of that $100 of the subsidiary's income in the US's income tax return, and the dividend did not occur. There was no dividend from that subsidiary in Netherlands to the US. So they're going to say to you, why am I including this income when I didn't distribute it from the subsidiary? And you have to say, well, unfortunately, you've gone awry of these GILTI rules or these Subpart F rules, and so now you have to pay income tax in the US even though you haven't had a distribution, right? And the new rules, these GILTI rules we're going to speak about, come from TCJA, but there were existing rules under the Subpart F regime that did the same thing. It's just that the GILTI rules are much broader. They pick up much more income than the Subpart F rules used to pick up. But the concept here was to stop incentivizing US multinational companies from leaving their profits offshore. So now these rules sort of pick up much more income regardless of distribution, and therefore don't allow the deferral of US income tax on foreign earnings as they did prior. That's the general reason for this. So I don't want to get into too many details based on timing with respect to how GILTI works, but GILTI will look at the income of your foreign subsidiary, and it will look at whether there's actual tangible depreciable assets in the foreign subsidiary. So potentially for a manufacturing entity who has equipment to manufacture, you might find that kind of tangible depreciable assets that may reduce your GILTI pickup to some degree. Very often your distribution entities have a lot less in terms of tangible depreciable assets, and therefore your distribution side tends to get less benefit against GILTI than your manufacturing side. And all of this is encapsulated in this QBI comment, this qualified business asset investment. There's some hoops you jump through and some math, and your tangible depreciable assets help you with respect to how much of that income you have to pick up under the GILTI rules. Okay, continuing on, there's a bunch of additional rules that can help reduce the tax burden in the US for income picked up by these foreign companies. And if you're a C Corp, so it doesn't work for an S, but if you're a C Corp, or if you're an individual, even individual owner of an S Corp, there's an ability to take advantage either automatically or with special elections of additional benefits to reduce the tax on GILTI income. And so these rules in this slide go through that. In short, without getting into all the details, first of all, foreign taxes paid by that, let's say, manufacturing or distribution entity are potentially available for credit in the US against the income. There's a haircut of 20% on those taxes paid. So if you pay 20 of tax, 20% of that is automatically not allowed. The other 80% of the tax you paid is potentially allowed, but subject to limit under some of the things we discussed before. Remember the limitation rules that we mentioned on sourcing of income, et cetera. So there is a potential for foreign tax credit, and there's a special deduction the US is giving at the moment that says whatever your GILTI income is you have to pick up will generally give you a 50% deduction against that. So you'll only pick up half of it effectively. which is an amazing thing. It's not really based on expenditure. It's a made up 50% deduction under the rules. So, to some extent, GILTI is not taxed as highly as other income because of an automatic deduction, but you have to work your way through that. We're going to talk about the Green Book proposals, which will reduce that 50% deduction to 25%. Interestingly enough, the proposal in the Green Book from last month says that would go through for 2023. It would actually be effective this year. I don't expect it to pass just because of the way the House and Senate is currently split. But if it did somehow pass, your estimated payments, even including the Q1 estimated payment that companies, individuals may have made last month, could be underreported for GILTI if you indeed would be subject to GILTI and we're relying on a 50% deduction, and this passed current year at 25%. Again, I don't expect it, but it is possible. And it could mean that your first quarter was underpaid to the extent you have GILTI and we're relying on a 50% deduction, which could change to a 25% deduction. I'll come into some more of that a little later. Okay. Coming into CFC distribution. CFC, again, are those foreign entities that you own and control. Generally speaking, if you do distribute that income, you'll pay tax on it, potentially not if you've already paid tax on it once before. And if you're a C corporation, you may have a special regime to not pay tax at all. So understanding how to tax distributions back becomes complicated if you're not an international expert. So that's something to keep in mind. Now, for CFC distributors, the entities that are in the distribution business, as we said, they generally don't have a lot of Q-buy, so their GILTI pickup tends to be higher. The manufacturers tend to have more tangible depreciable assets, and they pick up a little less. So that tends to be good. If you have foreign disregarded entities, and this is through things called check the box elections, where you get to choose the tax treatment of foreign entities, these rules don't apply. You just pick up all the income anyway in the US, and you don't have to worry about these rules. So we'll move forward. Manufacturers, as we said, pay a little bit less in GILTI. They tend to have that Q-buy. It reduces it. Okay. I don't want to get into the details of previously taxed, but I sort of said that sometimes you have to pick up the income before it's even distributed, regardless of distribution. There's a whole set of rules that say, well, if you're picking up income and you didn't get the cash, when you get the cash in the future, you may not have to pay tax twice, right? It doesn't make sense to pay tax on income before you get it and then pay tax on the same income once you get it. So there's a series of rules that you work through to identify whether you pay tax once or twice, and when do you pay tax, before distribution or only upon distribution. They are complicated, and a lot of people don't understand the rules well. A lot of smaller firms don't get it right. Even some bigger firms make mistakes. It is important that you work through this with your advisor to make sure that if you decide one day to bring back a lot of money, that you're clear as to how much tax you have to pay on that. I find that it's a simple question to ask and actually quite a complicated question to answer properly. So keep in mind that if you do have cross-border entities accruing income offshore, that it is not so simple to determine tax on bringing that back if you're a U.S. owner of that entity. We did run through an example. This shows you a U.S. corporation with foreign entities in different jurisdictions that it owns. And it sort of says, look, if you've got income or losses from different entities and you've got tangible depreciable assets and you've got all this stuff, this will work through the calculation and tell you how much income you pick up, how much foreign taxes you pick up, and how indeed to allocate those income and allocate those taxes to the different entities. And the spoiler alert in this example is the GILTI income was only 543. Some of it didn't have to get picked up. And of the 543 that was picked up, 494 ended up in one entity, 49 ended up here. This entity picked up no GILTI because in the example, this entity actually was running at a loss. And so it didn't have to pick up any of the GILTI, and it actually reduced some of the total income picked up. Again, a complicated calculation when done fully. This was sort of just a high-level example, but this is the way it works. And there's all kinds of calculations that you run through, and they go on the tax return, and there's forms for it. And happy to delve into those details if anybody wants to, or has a question about it. Feel free to throw it in the chat, and I'm happy to go through it. I just don't want to miss some of the other slides as we run through time, and want to make sure we save some time at the end. Okay, so how do you mitigate the GILTI when you have it? Well, there's a few ways to do that. First of all, there is this high tax exception or exclusion election. The US does want to pick up income from foreign entities if not picked up before, but if you pay enough tax in the local country where your distribution entity is or where your manufacturing entity is, you can exclude that income from these calculations. So, earlier I had mentioned Netherlands, then the Dutch tax rate is about 25% if you make, decent amount of income in the Netherlands, and therefore 25% would be considered enough to exclude that income from tax under these special rules under GILTI. There's another way to get rid of these calculations and burdensome reporting requirements, which is what's called the check the box election. The check the box election functions to treat these entities as if they were part of the US business. So it doesn't take the income and defer it. It just automatically picks up all the income. So you don't have to go through these calculations as to whether the income is GILTI or not, because you're picking up all the income all the time, no matter what. So, the check the box election does mitigate the requirement to think about GILTI, but it doesn't defer anything. Whereas the year by year high tax exclusion election could actually potentially defer income in a foreign corporate entity until you make a dividend. So some of these are tactics that are more useful than other tactics. If you do what's called a covered asset acquisition, which is a fancy term for buying a foreign entity, where you buy enough of it and you make special elections and you treat the purchase of the entity as a purchase of the assets of the entity. Well, if you get a basis step up in your assets, we'd said earlier that there's this Q-buy benefit that says if you have tangible depreciable assets, it reduces your GILTI. So anytime you're going to buy a company, if you can either buy the assets or treat the purchase of the stock as a purchase of assets, you can increase the basis in your assets and decrease your GILTI, because the way the calculation works today is tangible depreciable assets in the entity reduces your GILTI pickup. So that's what that bullet means. And then, of course, if you're making money in the entity instead of distributing it, if you start buying more and more tangible depreciable assets with the profits, you're going to constantly increase the assets available to reduce your GILTI pickup. Now, a lot of these things may not hold true when we get to the proposals in 2024 in the Green Book, because this benefit for tangible depreciable assets is on the chopping block. And the proposed 2024 Green Book proposals will potentially eliminate any benefit for having tangible depreciable assets abroad. So to go and do this is great under current law, but would provide zero benefit under the proposals. And the concept was they did not want to incentivize companies to reinvest foreign earnings offshore into foreign assets. They wanted to incentivize them to bring the money back and grow the US economy. And so when we get to the proposals, you'll see that this benefit is on the chopping block. Subpart F income is the sibling to GILTI. It's been around since before 1962. It does pick up a lot of income, and it's actually the test you do before GILTI. I'm speaking about it after because GILTI is more prevalent, but in terms of the tax technical ordering rules, Subpart F is the regime you look at first. And it actually has quite a bit of applicability in the manufacturing space that a lot of people don't realize. If you buy, for example, from a related party, so if you have a US company that has, in my example, I think we said a Netherlands subsidiary, and the Dutch subsidiary buys inventory from the US parent, and then Europe, the sales by the Dutch sub outside of Netherlands, so if it sells to countries other than the Netherlands, is all going to fall under the Subpart F regime as a general matter. Subpart F includes what we call foreign-based company sales income, and the definition includes if you buy property from a related party, and if you sell it to someone else who's not located in the same country as that foreign entity, and it wasn't manufactured by that foreign entity, or manufactured in the country of that foreign entity, it's Subpart F income. It means that income is automatically picked up in the US, even if you don't distribute. So in my example, if the Netherlands buys inventory that it didn't make from the US and sells it to any other country in Europe but the Netherlands, the income that's made in the Netherlands on that sale is immediately included in the US, regardless of distribution. So people get surprised to find that out. That's only one permutation of foreign-based company sales income. There are other permutations, but I just wanted to give one as an example, just to show how it can apply easily in the manufacturing and distribution space. There are some exceptions here and there, including if the tax rate is high enough in the local country, including if the sale the manufacturing of that inventory, even if it's purchased but from a related party, if it was manufactured actually in the country of the Netherlands in this example, you could get out of it. So, it is helpful to speak to an international expert about how you operate your international buying and selling, both your manufacturing side and your distribution side, because we would generally want to, one, minimize all your global tax, but two, help relieve the immediate pickup of income that otherwise might occur based on the way you're operating if you don't know these rules and you're not purposefully avoiding them. And you should be speaking to someone to help you make sure you're avoiding them. But if you're not, you're going to end up picking up tax in the United States, picking up income subject to tax in the United States that you had no intention of picking up in the US because you intended to defer it offshore. It also occurs with services. If you've got, services being provided by one entity on behalf of a related one or to a related one. So the on behalf of often is, you might have an entity who's dedicated to, warranty and dealing with services around the warranties of things that are being sold, et cetera. And if they provide that service for a related party who sold a product to a third party, and then this related party is going to provide that service on behalf of them and provide warranty type service or other service, all that service income is automatically picked up in the US regardless of distribution, because it would be treated under the Subpart F regime as foreign-based company services income. So again, the high-level thinking here is you need an international expert to understand how you plan to operate your business and make sure that we operate in a way that doesn't trigger these rules and disallow the deferral that you thought you might have. There are exceptions again here too, and we can work with these exceptions to qualify for them. We change the way the contracts are drafted and things like that, make sure that the work is being done on the entity's own account and not behalf of a related party. And there's a lot of other things we may be able to do to help reduce the immediate pickup by accident. Okay, we're going to move from these anti-deferral rules that we spoke about to the FDII regime for just a couple minutes. This is a regime that's only applicable to C corporations, not applicable to S corps and individuals. And it generally incentivizes C corporations to export their goods and services. And if you export your goods and services, instead of paying the 21% federal tax rate that C corps currently pay, they would presumably be reduced, subject to certain things, but down to 13.125%. And then after 2025, it would go to about 16.4% under current law. So it really is just trying to get US C corps to be net exporters instead of us generally being net importers, and it can reduce your corporate income tax rate. Now, important to know that if you do have tangible assets in the US, it can reduce your ability to do this. So you have to be careful about how much tangible depreciable assets you have in the US. And it doesn't matter if the income is US or foreign sourced. In the beginning of this presentation, we talked about how to source income. Here, it really is not based on sourcing, it's based on consumption. If you are exporting a good or service that's consumed outside the US, doesn't matter where you provided the service, you can provide the service in the US. But if the consumer of that service was outside the US, you can potentially get to a 13% tax rate on that income as opposed to the 21 that we have generally. So there are some leeways here that we don't have in some of our other regimes, like the IC DISC regime, which you may be familiar with in this space, that also gives you some tax benefit for selling goods that were US manufactured, but selling goods. So this is a different regime. Now, for this regime to apply, there's a bunch of calculations as well. You have to have income that is deduction eligible, and that's just a fancy term for the kind of income they want to incentivize with a lower tax rate, right? You have to have that kind of income, and that kind of income doesn't include everything. So there's, things like Subpart F and GILTI income that we talked about does not fall into this regime. If you have at the very bottom there, foreign branch income, so if you check the box on an entity, the income from that entity that was checked that flows through into the US is not eligible for this. This really has to be exportation of goods and services by the US entity itself, not through a disregarded foreign entity that you created. So some exceptions to that, but otherwise, indeed, there is an exportation of goods and services rule for C corps that reduces their taxable income by giving them a made-up deduction against their income related to exportation of goods and services. So it's one that I think is complicated for people who are not sure how to calculate it, but it can provide real immediate benefit and a reduction to tax due to a C corp And if you have, goods or services used outside the US, it's well worth considering that. Now, there is an interplay between the FDI regime and the GILTI regime. FDI is this exportation regime, and the GILTI is the pickup from your foreign subs. So if you've got both exportation of goods and service by US entity, US C Corp, and it also is the owner of foreign subsidiaries that might be manufacturing or distribution subsidiaries, you could have both regimes that have to be considered. And they can't give you the deductions against both regimes if it gives you a loss in total. So there are special rules and forms 8993, but special rules and special forms to deal with that interplay. And again, that's where you're going to need an expert to help you do that. Can I go back to 49? It went by too fast. I can do that, yes. 49, FDI requirements. So in terms of the requirement, so coming back to 49, this is the requirements to get the reduction on the exportation of goods and services. So first, if you're doing sale, property has to be sold by the corporate taxpayer to a person who's not a US person. And the intent is that the use of that foreign item would be abroad. And by the way, this might be able to be done. Okay, thank you. Yes, they will be provided as well. Thank you, Melissa. This can be done, by the way, to a related party. So you could sell to a related distributor entity that's in a foreign country that's owned by the US corporation. And that related party sale under certain rules is eligible in the US for that reduction. It doesn't have to be an automatic sale to a third party. It could be to a related party, but if it's to a related party, there's a little bit more hoops you have to jump through to make sure you can qualify. For services, if you provide a service to a non-US person, that service could be provided within the US, but the consumption of that service has to be to a non-US person. And that could also be, you're welcome, that can also be to a related service provider potentially, as long as you meet certain hoops as well. So that means you can't bring it back into the US either. You can't sell a product to a foreign related party, take the deduction, sell it right back to the US, and then sell it to a US, ultimate US consumption, US third party. That kind of stuff doesn't work. But there is some room there for the right set to work. So now moving forward to the Green Book proposals, this is specific to GILTI, and I had sort of mentioned that 10% QBI, that's the tangible depreciable asset benefit, is looking to be repealed. There would be no benefit to having that. The 250 deduction, that's that made up deduction, which is currently 50%, would be reduced to 25%. And I said earlier that they're looking to do that effective for this year potentially. Now, the corporate tax rate is also, this is not an international issue, but the US corporate rate is up for debate. They want to increase it from 21% to 28%. If they did that, it would also affect GILTI income. GILTI income is taxable at the corporate rates, which if it went from 21 to 28, along with a reduction in that 250 deduction from 50 to 25%, could give rise to an effective 21% tax on GILTI, where today the effective tax rate on GILTI is only 10.5. So that would double the effective tax rate on GILTI income if these provisions passed. Additionally, they want to make some other changes that are pretty important. They want to make this limited to jurisdiction by jurisdiction. Right now, you just take all the foreign entities and sort of group it all together and calculate GILTI. Here, they're going to separate it. So if you have losses in the Netherlands, you can't offset it against income in Germany, and that could provide issues for those who have companies in different countries. But they do want to give some benefits to losses from previous years and from foreign taxes paid in previous years within the same country to help reduce GILTI. So that's a beneficial rule. And then foreign tax credits, which you can use. Today, you can only use 80% of them. They want to move it to 95% of it. The bottom line is there are some good and some bad in here. And unless you model out for your particular facts, the good and the bad, you won't know for sure that if this passes, how will it affect you? But of course, people like us can definitely do that. We're pretty good at modeling those things out and can help you understand how those proposed changes could impact you going forward. So that was, high level, a whole lot of questions and discussions on international tax and some of the most important rules that come from them. We do have 5 presentation. I know that I've tried to keep track of the 1 or 2 comments in the chat and answer them, but nonetheless, I'm sure Mike and I would be happy to answer any questions or open it back up to Melissa for final comments.
Thanks so much, Andre. I think amongst you, Jeff, and Mike, you could do a full day seminar on this, but again, appreciate you drilling down and condensing what is a really meaty topic. I'm not seeing any questions in the queue. A final reminder to folks, there's a Q&A and a chat box at the bottom right portion of your screen. While we wait for questions, maybe I can turn back to the presenters if you have any final thoughts. Jeff, if you had any questions for Mike or Andre that you wanted to highlight.
Yeah, just one for Andre. Andre, we've been very successful recently working with some of our global clients in getting cash back to the U.S. One of the products that you work with them on is a kind of a supply chain management. Maybe you can explain that process a little bit. That may be something of interest to the audience.
Yeah, I think that'd be great. And it's actually, I'm glad you bring it up. What happens is, as you grow your global supply chain, very often you may end up manufacturing in countries that are cheaper. Where, if you want to stay close to home, you can set up a maquiladora in Mexico, but in China, there's cheaper manufacturing, as well as some other countries. And then your distribution network can start to grow as you distribute outside the US. And when you look at your entire supply chain, you may have haphazardly created entities and are paying tax all over the world. But there is an ability to look at the way you operate from a global perspective and say, well, how can we minimize your global effective tax rate? In other words, paying the least total tax through all your entities by making sure that the right activities are conducted in the right countries with the right profit margins in those countries. And so, it's not an easy thing to do because it takes time to understand what you're doing and then to rework the way you operate your supply chain. But you can have substantial global tax savings from not doing things haphazardly, but rather building your supply chain from the ground up or rebuilding it from the ground up with tax efficiency in mind, right? And so we can sort of help do that along with making sure you get the deferral from all these regimes we spoke about and reduce tax on the distribution of profits back to the US. So I think a global look at what you do can yield some pretty positive results.
Thank you. And then as companies in the U.S. are looking to do more business on a global basis, I know the few of the clients that we've had discussions of late, the jurisdiction in which they set up their foreign domicile is very important from a structuring perspective, most likely for the treaties in place. Maybe you can elaborate on that?
Yeah, I mean, your point is well taken. I mean, you do want to go where the business says you should be, but when you have opportunity to pick from a few jurisdictions, there are countries with which we have income tax treaties. Those treaties may allow you benefits that you might not have received if you went to one of the other countries. And so, you want to make a good business decision, but tax and total tax paid is part of that business decision. And treaties and other things may help sway you one way or another.
Perfect. Those were the two items that I was thinking about. I don't know if any questions have come in.
No questions in the queue.
Okay.
And Jeff, I'll turn back to you and Mike and Andre. Any final thoughts for the audience that you'd like to share in our last minute or so?
Yeah, I always just say, thank you to you, Melissa. The group does a great job supporting the business community, both domestically and abroad. So thanks again for allowing us to participate. And Mike and Andre, it's always a pleasure to co-present with you. And we'll be available for questions at any time. This will be circulated, and you could always find us on LinkedIn or at marcumllp.com.
Excellent.
Like
Well, again,
question that came in.
we did have we did have
transfer
one.
pricing. Yeah, perfect.
All right, let me see if I can get this transfer pricing. Let me see if I can read this from the beginning. Okay. If we have an intercompany agreement in place based on transfer pricing study to minimize cost of the wholly owned sub, we still need to pick up the income in the US. Yeah, a transfer pricing study, which you should have, and I'm glad you do, will help allocate the income properly between the two jurisdictions, but it has no bearing on whether the properly allocated income to that foreign entity is subject to the GILTI or the Subpart F rules. It just means that the proper amount of income was in the entity, that you now have to debate whether it's picked up under Subpart F or GILTI. But it doesn't make that regime go away just because you've allocated income properly between the two entities. But it's a great question. Yeah.
Excellent. Thank you very much, David, for the question. And again, Jeff, Andre, Mike, appreciate your time and sharing your expertise with us this morning. And again, I'll be sending out a copy of the slides as well as the recording the presentation the next day or so. So thank you again, everyone. Have a great rest of your day.
Thank you.
Thank you.
Thank you.